Welcome back to Hana Invest TV, where we analyze the harsh financial realities facing homebuyers in the economy of 2026. Today we tackle a burning question: who can actually afford a $250,000 starter home in this market? Everyone talks about the American dream, but the math behind owning a home has changed drastically in just a few years. What used to be considered an affordable price point is now a financial trap for many unsuspecting middle-class families across America. We're going to break down every single dollar involved, from the down payment to the hidden costs that destroy budgets. Your salary might look good on paper, but purchasing power has eroded significantly, making real estate harder to reach than ever. Let us start by finding where these $250,000 homes actually exist in the current housing market landscape. You can still find homes at this price point in places like Ohio, parts of New York, and the industrial Midwest. However, availability does not mean quality, as most homes at this price point are aging structures that desperately need major renovations. These are often fixer-uppers, meaning the initial purchase price is just the entry fee to a world of expensive repairs. Online listings use wide angles and filters to hide the truth, but the reality involves outdated systems and structural issues. Many of these properties are sold as is, forcing the buyer to absorb all the risk and cost of immediate maintenance. Imagine walking into a kitchen that has not been updated in 40 years, realizing you need another $20,000 for renovations. The bank might tell you that you are approved for the loan, but bank approval is not the same as affordability. Lenders only care if you can pay them back, not if you have enough money left over to actually enjoy life. Now let us talk about the first major hurdle, which is the down payment required to secure a home like this. To avoid private mortgage insurance and get the best rates, you typically need 20% down, which is $50,000. For the average household, saving $50,000 in cash is a monumental task that can take more than half a decade. If you save $800 every single month, it would still take you over 6 years just to reach that number. By the time you save that $50,000, home prices might have risen further, moving the goalpost even further away. This forces many people to put down less than 20%, which triggers higher monthly payments and expensive mortgage insurance fees. Let us assume you manage the down payment and secure the loan. Now we must calculate the monthly mortgage principal and interest. With interest rates hovering around 6 or 7%, your payment goes primarily toward interest rather than paying down your home equity. In the first few years of a mortgage, almost all of your monthly payment is just profit for the bank, not you. For a $200,000 loan, the principal and interest alone will cost you roughly $1,500 monthly. Many first-time buyers stop their math here, thinking they can afford it, but this is a dangerous financial mistake to make. We must now add the 3 silent killers of wealth: property taxes, homeowners insurance, and the inevitable maintenance costs. Property taxes vary by state, but on average you should expect to pay around $250 every single month. Homeowners insurance is mandatory if you have a mortgage, adding another $100 or more to your monthly bill. Then there is maintenance, which is the most overlooked expense. Things break, roofs leak, and appliances fail without any warning. Financial experts recommend saving 1% of your home's value annually for repairs, which is roughly $200 a month. When you add these hidden costs to your mortgage, the real monthly number is much higher than what Zillow told you. The true cost to own this modest starter home is approximately $2,113 every single month. This is the number that drains bank accounts and leaves families with zero flexibility for vacations, investments, or emergencies. If you did not put 20% down, add private mortgage insurance to that total, pushing your costs even higher. Now, let us compare this monthly obligation against the income of the average American household to see the real damage. The median household income in the United States is currently around $84,000 per year before any taxes. However, you do not take home $84,000. Federal taxes, state taxes, and deductions take a massive bite out first. After Uncle Sam takes his share, the average family is left with roughly $5,500 in net pay. Let us introduce the Smith family, an average household earning $84,000. Trying to survive the American housing dream today. They bought the house because everyone told them renting is throwing money away, but they did not calculate the full budget. Right off the top, the house takes over $2,000, leaving them with roughly $3,400 for everything else. They need 2 cars to get to work. Car payments, gas, and insurance easily cost another $1,000 a month. Groceries for a family of 3 have skyrocketed. They spend at least $800 a month just to eat basics. Utilities, internet, and phones add another $400. The money remaining in their account is shrinking rapidly every week. We cannot forget student loans or minimum credit card payments, which average around $400 for many typical households. Miscellaneous expenses like clothes, medical copays, and household items take another $300. The budget is now critically low. After paying for the house and basic survival, the Smith family has exactly $77 left at the end of the month. $77. That is their entire margin for error. One flat tire or one doctor visit puts them into debt. This is the definition of being house poor. You own the asset, but the asset owns you and your freedom. They cannot invest for retirement, they cannot save for their child's college, and they cannot take a simple family vacation. Financial stress is the leading cause of divorce, and living with this tight budget creates immense pressure on relationships. Real estate agents and mortgage brokers get paid when you buy, so they are incentivized to push you to your limit. Just because you qualify for a loan does not mean you can afford the life that comes with that loan. True wealth is not just owning property, it is having margin in your life to sleep well at night. Sometimes renting a cheaper place and investing the difference is a smarter financial move than buying a house you cannot afford. If the Smiths rented for less and invested that surplus, they might build more net worth than by paying mortgage interest. Homeownership is a second job. You are the landlord, the repairman, and the gardener, all while paying for the privilege. The housing market in 2026 requires a new strategy. You must be defensive and calculated with your hard-earned money. Do your own math. Do not trust the bank's numbers. Build a budget that leaves you with breathing room every month. Wait until you have a larger down payment or higher income. Patience is the most powerful tool in real estate investing. There's no shame in waiting. Walking away from a bad deal is the best financial decision you will ever make. Imagine a different future for the Smiths, where they prioritize cash flow over home ownership status and built real financial security. Plan your finances 5 years out. Ensure that your housing cost never exceeds 25% of your take-home pay. When you control your housing costs, you control your time. That is the ultimate freedom that money is supposed to buy. Save aggressively, invest wisely, and live below your means. This is the path to winning in this difficult economy. The housing market will always be there. Do not let the fear of missing out drive you into a financial disaster. We hope this breakdown has given you a clearer perspective on the true cost of buying a home in 2026. Financial literacy is about seeing the full picture, not just the monthly payment the bank salesman wants you to see. If you found value in this analysis, please like this video and share it with anyone thinking about buying a home. We are dedicated to helping you navigate the complex world of investing and personal finance with honesty and transparency. Remember the numbers. $250,000 is not cheap, and $2,100 a month is a heavy burden. Navigate your own path. Do not follow the herd into a mortgage that will keep you working until you are 70. Your goal should be a life of abundance and options, not a life of stress and living paycheck to paycheck. Plant your seeds carefully. Renting is not a failure. It is often a strategic pause to build a stronger foundation. Be smart, be calculated, and never let emotion dictate the biggest financial purchase of your entire life. Every light in this city represents a mortgage. Make sure yours is the one that allows you to sleep peacefully. Thank you for joining us on this deep dive into the real cost of homeownership in the modern economy. Check out our other videos for more insights on real estate, stock market investing, and building generational wealth. Stay disciplined with your budget, keep asking the hard questions, and always verify the math before you sign anything. This has been a Han Invest TV production. We are here to empower your financial journey every step of the way. Do not forget to hit that subscribe button and turn on notifications so you never miss our future financial updates. We appreciate your time and attention today. Your financial education is the best investment you can possibly make for yourself. Remember, money is a terrible master but an excellent servant. Make sure it is working for you, not against you. Until next time, keep saving, keep learning, and keep building the future that you and your family deserve. Follow us on social media for daily tips and behind-the-scenes content. The links are in the description below. We will see you in the next video. Take care of your finances, and they will take care of you. Trust your instincts and stay the course. The road to financial independence is long, but it is worth every step. Thank you for watching Han Invest TV. Subscribe for more financial wisdom and build true wealth, not just a mortgage burden. Goodbye for now. Stay smart, stay safe, and we will catch you in the next episode of Han Invest TV.